Another thing I've come to realize over the past 25 years gets back to Munger's first rule: never interrupt compounding. That means that you should not design your portfolio for normal times. Instead, design your portfolio to survive during the worst 2% of times, to avoid interrupting compounding's magic. That basically mandates a portfolio that most people would call suboptimal. That is a quote from the chapter of the book that I'm going to be talking about with you today. It's just continuing in our series on the book written by Christine Benz called How to Retire. And this installment is a conversation she had with William Bernstein. So William Bernstein has been in the kind of financial planning or personal finance literature for a long time. Christine describes him as William Bernstein is the classic polymath. A neurologist by training, Bill turned his attention to investing because he wanted to figure it out for himself. Oh, to have that level of intellect. A blog and numerous acclaimed books followed, including The 4 Pillars of Investing, If You Can, and The Intelligent Asset Allocator. So I've read a couple of William Bernstein's books, or Bill Bernstein as she's going to call him here. And if a person came to me, or a young person or a person who was just interested in getting into investing, and they asked, is there an author out there that you would recommend? He's certainly one that would come to mind because his books will give you a very good foundation for all of the various topics you're going to come across in financial planning. So asset allocation, tax management, charitable distribution planning, estate planning, risk, return, all of the kind of basic things are going to be covered by William Bernstein. And then what I found interesting about this particular installment is there have been previous chapters that we've had a lot of agreement with. So spending your money in order to be happy, and some of the discussions last week or the last installment we did on the real reason a person would buy an annuity isn't necessarily for the lifetime income stream, but how that lifetime income stream makes them feel. There's a lot about this chapter that I disagree with. And I think that that's a healthy balance to this podcast. Is not every author that she interviews is going to be 100% in line with the advice that maybe Scott or I would give a person on how they should best manage their assets in retirement. So let's get into some of the things that she and Bill discuss, and I'll give you a little bit of my pushback as we go along here. So the first question that Christine is going to ask him is, let's start with a really basic question. How should I change my portfolio as retirement approaches? And Bill is going to give a fairly long-winded answer that he's going to distill down to essentially 4 components or 4 questions that a person should have answers to before they can go about the business of constructing a portfolio in their retirement. So his first question is, what is your spend rate, or as he calls it, your burn rate? And he styles this as a percentage of your portfolio. And his point being is, we really need to get an idea of how much of your portfolio you're going to consume every year before we can go about the business of constructing a portfolio to satisfy that income need. That's not necessarily a terrible place to start. His next question that a person needs to answer is your age. And your age, in his view, is really going to dictate for how long is this portfolio going to need to sustain your income needs. His point being, if you're 40 and you've retired quite early, your portfolio is going to be vastly different than a person who works toward their 80s, because the needs of those portfolio, the liability of that portfolio is going to be dramatically different. Whereas a 40-year-old might have 50-plus years of cash flows they're going to have to produce from their assets. An 80-year-old, they might only have 10. So that would indicate differences in how the assets would be invested. And then the third question is, what is your risk tolerance? And that kind of feeds into the fourth question, which is, what is the balance between how much you want to consume during your life and how much of a legacy you want to leave with your money, or how much do you want to leave as a bequest? Because if you're very interested in leaving a lot of money to your heirs, clearly that's going to indicate a different asset allocation strategy than if you're very interested in just preserving your capital and consuming as much of it as possible while you're around. So those are his 4 questions. What's your burn rate? What's your age? What's your risk tolerance? And what's the balance of interest between bequest and current consumption? Now, I'm going to give a little bit of pushback here. So when we do our financial modeling, there are 4 things that we need to answer, or there are 4 questions we need answers to from a client in order to go about the business of establishing an asset allocation. And those questions are, what do you have? So what is on your balance sheet? What assets do you have at your disposal to actually finance your retirement? The other question that follows right along with that is, what do you need? And this is kind of one of the questions that Bill is asking here, is what's your burn rate? The question to our client is, in dollar terms, not as a percentage of your portfolio, because that's not the way that real human beings think. It's telling us in dollar terms, what do you think you're going to need to withdraw on an annual or monthly basis in order to live the life you want to live in retirement? So those are the first two legs of the equation. What do you have and what do you need? The third leg of the equation is for how long are you going to need this? Now, there's a little bit of uncertainty baked into that cake, right? Because if all of us knew exactly when and where we were going to die, that would make planning a lot easier than it is now. But death is sort of an uncertainty that exists in most cases well out into the future. But financial planning software will largely give you a very conservative estimate. By that, I mean they're going to elongate the period over which your portfolio will need to sustain your income needs. So that's the third leg. So what do you have? What do you need? How long are you going to need it? And then the last piece is how much do we think we can get on our invested assets, and how much risk do we need to take to get it? And if we take too much risk, what happens? So the pushback generally that I'm going to have here is this term risk tolerance. It's a nebulous term that is turned into a meaningless phrase, or it has one specific meaning: volatility. Clients don't like seeing the value of their portfolio moving around a lot. And I think that to define risk tolerance as our inability or unwillingness to log into our accounts and see the value change, that's a dangerous way to define your risk tolerance, because near term, you might be uncomfortable with the value of your equities, as we've seen in, say, the first quarter of 2025, declining slightly. And that might predispose a person to under-allocate their portfolio to equities, because that will make them feel good about their portfolio in the near term. They'll log in every day and they'll see they have a very stable value. However, what they jeopardize is running out of money in the long run, where there's this distant and uncertain future. It's not as easy to see, but if we don't get the necessary growth on the assets to sustain a 30-year retirement, it's kind of like the old saying, and I forget, it's probably misattributed to Mark Twain, it's how did you go broke? And the response is slowly at first and then all at once. And that's sort of the pernicious effect of inflation on a portfolio is if you don't have enough exposure to growth assets, you might feel good about where you are positioned for the near term, but you can run out of money in the long term. So for Bill, when he's saying he's constructing a portfolio based on the perceived risk tolerance of the client, I'm not sure he's really getting at what that means. And rather than doing that in that order, so finding out what a client's risk tolerance is and then constructing a portfolio of assets that's going to assuage that tolerance, we like to do that in reverse. So we see what the client has, we see what they need, we see how long they need it for, and then our job as an advisor is to construct a portfolio that will allow them to achieve their goals while taking the minimum amount of risk in order to do that. But that risk might be packaged slightly differently than a client is used to receiving it. Okay? So that's sort of the pushback on the first element here. Christine goes on. In the past, a lot of people who were retiring would simply rely on Social Security plus any income that their portfolio was kicking off. Focusing on income production is the old-fangled way to create a portfolio for retirement. Is that a good way for people to go about it? And this is kind of this spend the eggs, so to speak, but spare the goose style of investing, where you're going to construct a portfolio, it's going to produce dividends and interest payments, and all you're going to do is clip those coupons or take those dividends and spend that, and you're going to preserve the corpus, which will ideally continue to kick off enough income year over year to pay for your retirement. And this is where Bill and I are actually in agreement. He says it's a terrible way to go about it because it's subject to the money illusion. So what he means by the money illusion is that if your portfolio is not increasing its yield year over year by the amount of inflation, you're really moving backwards in real terms. So that is where our agreement ends. And we'll see in a second why it ends there. And so Bill says, say you buy a nominal annuity, which is just an annuity that is going to give you a nominal rate of return, which is not adjusted for inflation. A single premium immediate annuity that yields 7. You think that you've got this income that's going to sustain you for the rest of your life. What you don't realize is even if there's modest inflation over the next 20 or 30 years, in your later years, you're going to be getting back what today you would be considered, what could be considered funny money. That's because your cost of living is going to double, triple, or quadruple. That's really the problem with the old way of looking at things. Now, I agree with Bill in the first assessment. Constructing a portfolio of assets that's only designed to kick off a certain amount of income every year where you never invade the corpus, that is a terrible way of allocating your money. But I don't think it's terrible for the same reasons that Bill thinks it's terrible. And the reason for that is Bill has, in some instances, the curse of knowledge. He's not a practitioner in the space. He's never sat across from another human being tasked with allocating their capital, tasked with investing on their behalf. He has these neat and highly stylized examples that he's going to provide here, but those exist well within the confines of an academic paper. They don't really persist in the real world. And this is an exact case, because he says your cost of living is going to double, triple, or quadruple over a typical retirement. What Bill doesn't have that I do have, having worked in the space for a decade, is we have the raw data from our clients. We run reports for our clients when they come in to demonstrate, here's what you had 10 years ago, here's what you've spent year over year, here's what the portfolio has returned, and here's what you have now. And their costs do not go up by the amount of inflation every single year. It's very unlikely that we see cash flows coming out of their portfolios that double. And I do also have a slightly blinkered view of that, because yes, their Social Security does get a cost of living adjustment, and that helps offset distributions that they're taking from their portfolio. But certainly, if Bill's point here were correct and the cost of living were going to quadruple over the case of a typical retirement, we, actual practitioners in the space, would have real good data to support that. But as we talked about in the last installment with the research that David Blanchett has done, he popularized the retirement planning smile. And Vanguard did a study which demonstrated that in real terms, the spending that a retiree needs to do over their life, it starts out the highest it will be, and it declines on average by about 1% to 2% per year. It declines. It doesn't continue to go up. So I'm not real sure where he's getting this, quadrupling of your living expenses over retirement, but I can tell you in our experience that just has not been the case. He goes on. A better way is not to look at it from the point of view of income. This is income being produced by your portfolio, but from the point of view of treating it as a reverse mortgage. And then he has a qualifier here, not that he thinks reverse mortgages are a particularly good investment, and I would second that. What he means by that is, if you're in retirement and if you set up an asset allocation and you have pieces of the portfolio that are not going to be income producers, say you have some growth stocks, that's great. Like he's saying, you ought to have a piece of your portfolio that's not going to specifically be there to produce income. It's there to grow. And then the other part of your portfolio, you should be open to consuming it. So that's what he's saying, is you should go beyond just clipping the coupons from the bonds. And you could say, well, my stocks are going to produce a long-term total rate of return of something approximating an uncertain, 7 to 10%. But my bonds, they might yield something like 3 to 4, so I shouldn't feel too bad about not only spending the cash flow from the bonds, but actually consuming that portion of my portfolio so that my stocks can continue to grow unencumbered by, constant sales. And we would agree on that point. Christine goes on. This is another interesting thing that she raises with Bill. I want to ask you about a piece of advice that you're closely associated with. If you've won the game, quit playing. I take that to mean that if you've amassed sufficient amount of assets, you shouldn't take risk with that portfolio. You should stick with safer securities. Is that a good piece of advice for retirees? And Bill put some qualifiers in here. It's a good piece of advice for what he calls the median retiree. And I don't think that that's true. I think that there are two instances where this makes a whole lot of sense, where if you have a person who retires and they have real spending discipline issues and their asset base may or may not sustain them for their retirement, that's a person who I think should take very little risk in their portfolio or consider converting as much of their liquid net worth to a fixed stream of income that they can or that they're comfortable with, or that would be prudent based on the other risks of doing so. And the reason being is, if a person has spending discipline issues, or if their dollar amount that they need from their portfolio is such that they cannot sustain a prolonged drawdown, something we saw in the financial crisis, these people might be better suited for Social Security plus an annuity payment, plus maybe a real conservative allocation to income-producing assets from which they do only spend the cash, because that will allow them to, with as little risk as possible, sustain at least that amount of income year over year from their portfolio. And again, annuities are not guaranteed. I want to make that quite clear. If you buy a private annuity, there are some risks to owning it. Social Security is perhaps the only guaranteed payment that you can receive in your retirement. And then obviously if you own some assets and they're producing interest payments, those are also not guaranteed. But historically, this would be a very good way to produce a consistent stream of income that you're very unlikely to outlive for your retirement. I would say that this would follow an inverted U. So your risk profile for your retiree would follow an inverted U, where at the very left side of the distribution where you have a high rate of spend per dollar saved for retirement, that's where you probably can't take a whole lot of risk. And then on the other end of the spectrum, where you have a person who they are spending very little of their portfolio and they're mostly concerned with capital preservation, well, that person doesn't need to get a lot of growth out of their assets. So there could be a case where you're very well capitalized for retirement and you just don't need to take the risk. Maybe you don't want to leave a bequest. You just want to safely consume the assets you've saved. That's a good case for not taking a lot of market risk with the assets because you don't need it. But in the middle case, where it's not that clear, where say you're not on the borderline of running out of money, you don't feel the need to annuitize your portfolio, and you're certainly not on the other end of the distribution where you feel super comfortable and can probably spend and never worry about running out of money, you're kind of in the middle of that distribution. Those are the clients for whom the planning gets really interesting, because I think they are the people who need market risk in their portfolio because they need to grow their assets sufficiently in order to finance their long-range retirement. So Bill comes to kind of an opposite conclusion from me on that, but that's kind of the nature of this particular chapter. He does say something that I certainly resonated with, and he goes on to say this. This gets to the study that financial planning researchers Michael Kitces and Wade Pfau, and we will do a chapter on Wade Pfau in one of the next installments, did about something what's called the reverse glide path, which basically posits that the average person who retires should have a much higher allocation to bonds and a lower allocation to stock, and that stock allocation actually rises as they get older. Scott and I have alluded to this a couple of times, where if you're talking about risks in retirement, the folly is that as you get older and older and older, your allocation to bonds should be going up and up and up and up. And we did this in our myth-busting segment on should your age be concomitant with your bond allocation. So a 30-year-old should have 30% of their portfolio in bonds, and a 79-year-old should have 79% of their allocation in bonds, which would indicate that a 65-year-old who is just retired should actually have a riskier portfolio than a 80-year-old who is very near life expectancy or beyond. And that's backwards. And the financial literature has gotten this wrong for a very long time, and that's why we did a myth-busting segment on it. So that's where Bill and I kind of resonate. But the funny thing about that is he follows this up with an example on a bedrock portfolio that flies right in the face of this really good research. So Christine asks, if we were to think about a base case of a 65-year-old with a spending rate of 4%, so 4% rule, this is like right in line with our expectations for what a retiree might reliably sustain over retirement, and a self-professed moderate risk tolerance, again, they don't really do the hard work of figuring out exactly what it is that means, how would such an individual approach constructing a portfolio for retirement? And I even made a note to myself that says, what does risk tolerance mean? And then so Bill says, the single most important thing that a person in that situation should do, since they're at risk of running out of money, if they invest too aggressively, if they're at risk of running out of money, if they invest too aggressively, is to invest relatively conservatively. So far I track. The bedrock of their portfolio should be something that approximates a TIPS ladder. So a TIP is a Treasury inflation-protected security. This essentially reprices your principal based on expectations of inflation. But again, just for the purpose of the podcast, that doesn't mean these things never lose value. That doesn't mean that these things are risk-free. And it says that, so this TIPS ladder should mature in such a fashion that it pays off their liabilities every year. Let's say that you have a person who needs $70,000 a year to live and is getting $30,000 a year in Social Security. Social Security provides a real payoff because the amount you receive increases with inflation. Yes, those are those cost of living adjustments we talked about earlier. So they have to pay off the $40,000 deficit every single year, ideally. I say ideally because it's hard to realize perfectly in the real world. That's the only caveat that he will favor us with here. So they want to have $40,000 worth of TIPS maturing every single year for the next 30 years because that's as far out as TIPS go. They need $1.2 million worth of TIPS, 30 years times the $40,000 a year that they need. This should be the bedrock of their portfolio. I'm not saying to put it all in TIPS. It's not a problem to layer some stocks and nominal bonds on top of that as well. Well, Bill, you kind of are saying to put it all in TIPS because if a person has $1.2 million in TIPS and they only need to spend 4% of their portfolio, I'm not sure exactly how much of a portfolio you're talking about here. And part of me when I was reading this book is when you work with people, so in our business, people think it's money management, it's people management. And a difficulty with managing people who are now asking us to manage their money is people don't think what they feel, they don't say what they think, and they don't do what they say. You might have a person retire and say, wow, I really want to make sure that we preserve the capital. I'm not that interested in taking, these idiosyncratic risks out there in the market, and I'm not about that. I just want to spend my money and feel good about spending it. You say, all right, we can construct a portfolio of assets that will do just that for you. I have just the thing. But then they'll come back to you a week later and say, my brother-in-law, he gave me the stock tip. There's a company out there that's recording Where's Waldo for Audible. They think it's going to go to the moon. And you're thinking, all right. And so they say, I want to invest a portion of my portfolio in this hot stock. And you think, okay, this is a crazy deviation from the conversation that we had just last week regarding your interest in preserving your capital and producing a really reliable income stream from your portfolio. And I have the skill set in order to set that up for you. What I don't have is any primary research on a company doing an Audible version of Where's Waldo. I'm not even sure this is going to work. And so, but this kind of thing happens all the time where we are easily distracted. We're human beings. Again, Bill provides a really nicely, highly stylized example of a ladder of assets that matures in cash every year, and that cash pays for your expenses in retirement and adjusts for inflation every year. That sounds wonderful, but it is not how people work. That's not how people really want to invest their money. They get distracted by what their neighbor's doing, what their brother-in-law is doing. They want to keep up with the Joneses. There's all these sorts of idiosyncrasies that we come across with people and how they want to invest their money. So where these neat examples of how it should work in theory don't necessarily work in practice. Now, I think he does favor us with a little bit of a caveat there saying this doesn't always work in practice, but he should have said it virtually never works in practice. So I disagree on this point where the bedrock of a portfolio should only be this one asset class from the Treasury where you're getting this inflation protection on these securities. However, they are not as risk-free as Bill says. And Christine actually presses him on this a little bit. She says, well, will there be times when it would not make sense to invest in tips? For example, real yields on tips were negative not so long ago. Now, a negative real yield just means that principal protection they were providing wasn't going to adjust by the amount of the expected inflation. So it's not saying that you were paying to own this bond. It's saying the nominal yield plus the protection that they provided you for inflation were not enough to cover the inflation, which from my point of view makes investments like this kind of, I don't know. It makes me feel like the whole bedrock of your portfolio being an asset that could have a negative yield doesn't make a whole lot of sense to me. So she kind of presses him on that. He backs off of how tips and says that he wouldn't be buying tips under those conditions. And that's, again, where I think, okay, well, when you're working with human beings, it's not easy to say, here's the bedrock of your portfolio. It's a tip ladder, but there are certain conditions that happen cyclically in the market all the time where I would be very averse to buying tips. Well, what's your alternative? And again, I feel like that's the curse of knowledge or the curse of being an academic is he's never had to actually work with the human being for whom he's been entrusted to invest their money, as far as I'm aware, and come to them with real viable alternatives when one idea no longer works. All right. Beyond the bedrock, Christine, you mentioned earlier that an annuity would be vulnerable to inflation risk, but it's hard not to like the simplicity of a very basic low-cost income annuity. Does the lack of inflation protection make them a non-starter? Bill goes on, he says, I'm not a fan of those at all because they're subject to the money illusion. They're nominal. They're not inflation adjusted. So what seems like a nice stream of income when you're 65 might turn into funny money when you're 85 due to inflation. In addition to that inflation risk, there's also credit risk. And this, he does dig into the fact that private annuities do indeed have credit risks. We covered this. I mean, the data on households with annuities versus not in retirement does not indicate that they're more likely to run out of money. Indeed, it indicates that not only do they spend more money in retirement, they actually feel better about their spending. And the primary purpose is if you're in the weeds and you're an academic and you look at the history of inflation, I could understand how you would immediately assume that everybody is equally subject to inflation. So if CPI goes up by a certain amount, everybody's cost of living adjusts by exactly that amount. But that is really not the case. Most retirees have paid for mortgages. Most retirees are far more insulated from these changes to the cost of goods and services out in the market than, say, a 30-year-old with a family. So I could appreciate that. I needed income that helps protect me from inflation because I feel like I'm keeping my grocery store in business. So I'm very sensitive to the rising cost of groceries. But again, I'm in a very unusual and transient period of my life where we have a lot of children, we're feeding a lot of children, but that's not going to go on forever. And I can see into the future where there's going to be a point in time where our house is paid for, our cars are paid for, and our cost of living, or at least our core cost of living, are not sensitive to inflation, at least not to the degree that CPI would indicate they should be. And again, I think Bill kind of goes off the rails here by he's sort of a inflation protectionary hammer in search of an inflation nail, and he's creating highly stylized portfolios where the bedrock of that portfolio is to protect a retiree from the pernicious effects of inflation. That's an honorable position to take. I just don't think it's borne out in reality.
Okay.
They go on to talk about how stocks have generally been a really great hedge against inflation over the long run, and Bill and I agree on that point. So the last bit of insight that Bill gives us is an interesting question from Christine. So she says, are there any other pieces of parting advice for people who are embarking on retirement and trying to figure out what their portfolio should actually look like? And Bill says, if there's one thing I've come to realize over 25 years, I've been writing about finances, it's what I call the prom queen theory of life. If you're the prom queen, you tend to overemphasize the importance of good looks. In the field of investing, if you can solve differential equations and do real-time calculus as easily as most people brush their teeth, which is not my story, by the way, then you tend to overestimate the importance of that. What happens when you do that is you get long-term capital management. Now, long-term capital management is a hedge fund that infamously blew up entirely in the late 90s. You get people who are brilliant at math and think that everything is a matter of math. You forget about the Shakespearean part of investing, which is the history and their own psychology, and they wind up hanging themselves. The math is important, but don't focus on it entirely. The key to investment success is not another year of data or calculating out to another decimal point. You also have to focus on the things that are actually going to nail you. The cruel mistress of financial history and the face staring back at you in the mirror. And that is a phenomenal quote, and he captures that really nicely in this particular example. But what I found interesting was that kind of flies in the face of some of the information he gave us before, which was a very blinkered view of retirement where the only thing that you need to do is make sure to protect yourself against inflation. And that seemed to totally disregard the more Shakespearean element of that, which is there is an art form. There's particularly an art form when you're dealing with people, where if you go to the doctor and the doctor gives you some medication to address a concern that you have, he can't force you to take it. And so often in our work, as I'm sure any practitioner would tell you, we can come up with a portfolio to address the problem that a client has brought to our attention. That's sort of a coldly rational, mathematics-based answer. We have that. What the difficulty is conveying those ideas to a client in a way that will allow them to not only understand what it is that you're saying, but to make them motivated to actually adopt the changes that you suggest they adopt in their portfolio in order to meet the goals that they've just professed. Now, the real question is whether or not the client actually has those goals. Because like I said, clients don't think what they feel, they don't say what they think, and they certainly, in many instances, don't do what they say. So then Christine goes on to say, since you brought up long-term capital management, it seems like a related corollary would be not to put too much trust in experts, especially if they're recommending complex solutions and strategies that you don't quite understand. And so Bill goes on to say, that's a long way of saying that I don't pay a lot of attention to experts. I disregard people who are too eloquent and who are too rhetorically convincing, particularly if they have English accents. Now, I don't have anything against English, and my wife is a South African immigrant, and my in-laws have lovely South African accents, and I do love the way that they speak. But I think his point here is there's a lot of noise in the financial planning space. There's a lot of noise. There's a lot of so-called expert opinion and expert advice on what stocks you should be buying or selling, or what you should be doing with your money, or what products you ought to be putting your stuff in. And I think Bill's point of view here is, and this is something that Scott addressed on a podcast some time ago, you need to understand yourself before you can be a successful investor. And you need to know where your bright spots are so that you can stay near them, but you also need to know where your weaknesses are so that you can either hire a person to help you with that area, or so that you can be well aware of the pitfalls that you might step into in your retirement when you're making these, I think in often cases, irrevocable and often life-changing decisions with your money. And so Yes, there is an element of expertise that is necessary in this space. Obviously, my bias here is I think most retirees would benefit tremendously, and the data bear this out, from working with a financial advisor, mostly because everybody, including myself, everybody has an expiration date. Nobody gets out of here alive. And as it stands today, most men outlive their wives. And as it stands right now, most men are the people who are more interested in the financial planning topics than their wives. That won't always be true, and it's not true in every single case. But what that sets up is, in most relationships, there's a money person and there's a person who runs other parts of the household, has other interests, and it's not that they couldn't figure out the money situation of the household finances. It's just that they're not interested. And why would they be interested, or why would they force themselves to be interested if their husband or their wife has always figured this stuff out? And so, generally speaking, people as married couples, or just couples generally, they don't die at exactly the same time. And in most cases, one of the surviving spouses outlives the deceased spouse for many, many years. And that can set up a situation where, if the money person has passed away, leaving the surviving spouse, who's never had to contend with this before, on her or his own, to now all of a sudden run their portfolio without the help of an expert or a person that they have developed a relationship with, we can see terrible outcomes as a consequence of that. So yes, I think that there is the degree of skepticism that we should all kind of imbibe on a daily basis when we're hearing the financial noise and people on television like Jim Cramer, no offense, who are saying things, but he's never saying them directly to a single person. So I think Morgan Housel has a point where when you hear a bit of financial advice in the popular media, the question that you should be asking is, for whom? This is advice for whom? So I think setting up a relationship with an advisor where you can develop a personal and ongoing conversation about your specific needs, goals, wants, aspirations, fears, concerns, everything that entails in retirement, I think that's going to be a big part of actually setting up an asset allocation that will work best for you. So that was this week's installment. I know it was a lot of pushback on William Bernstein, but stay tuned because we'll have a few more episodes.
This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.